Ludo. Ooh, thank you, Ludo. That was an amazing way to kick off our day one. And now we're going to move into our next panel. And I'm very excited about this panel because I did, with speaking of excitement, skip through a bunch of the sponsors. You're going to see the sponsors everywhere, two of which are here on this panel, both incredible companies. Hersh Patel from Opacity Labs, come on up here, co-founder and CEO. We also got Shari Noonan, Rialto Markets, another amazing sponsor. If you haven't found the Wi-Fi, it is TT Wi-Fi by Rialto, and you can just connect. It's a public Wi-Fi. And then, of course, Morgan Krupetsky from Ava Labs, Avalanche, one of the top chains in RWAs, also have the pleasure of knowing for a very long time. And last but not least, I want to introduce one of my co-creators here of the TokenizeThis conference, Jason Barraza. Come on up here. He's going to be moderating, leading the institutional strategy here for RedStone. So I'll let you take it away. Cheers.
Good morning, everyone. Thanks for coming to TokenizeThis 2026. This is the fourth year that we're hosting this, the first year under the RedStone umbrella, and excited to be on this panel. I think we have people that have been in tokenization for a long time. Some of us have been preaching this for anywhere from half a decade to maybe a decade at this point. And it's finally taking off. There's institutional traction. There's use cases that are coming into production, but we're going to get into all the details. So again, some of us have been talking about this back to like 2017, 2018. Tell us a little bit about maybe what the initial thesis around tokenization was, and what were maybe some of the go-to pitches back in the day.
Do you want me to start? I'm happy to start. I feel like I've been living this in dog years. So Rialto Markets, we're a FINRA member broker-dealer. We have an alternative trading system, and we also have a transfer agent, all digital as well as traditional across private markets. And really back in 2017, 2018, when we first got into this space, it was about the efficiency and being able to really increase the efficiency. And what we're seeing today is more about the ability to disaggregate economic governance and access rights across different user bases. And so being able to really customize an ownership and really not having an investor just as a source of capital, but also as a stakeholder as part of that ownership journey.
Maybe just to add, and we'll talk about, I'm sure, kind of what makes this time different, but in terms of back in 2017, I think there was a broad misconception, which I think to some degree has kind of carried over into today, that if you tokenize something, it becomes more liquid. And generally speaking, back in 2017, a lot of the things that were being tokenized self-selected for crappy asset quality, right? The idea was like, if you can't access traditional capital markets, whether as an institution or as an individual, come on chain, and there's a pool of kind of crypto capital that would buy into or lend you capital. Again, I think that's true to some degree today, but I think that was largely the idea and partially why it didn't kind of really take off back then.
And from my perspective, Hersh, co-founder of Opacity Labs, the main innovation of blockchains when it comes to finance, in my opinion, is DeFi. The ability to have decentralized capital formation, get better capital utility, even though like DeFi summer came after, probably people started talking about the benefits of tokenization. I think the main goal from my perspective is getting traditional securities into a DeFi context and getting rid of a lot of the fat in the middle of our financial market system and getting better access, better capital utility, better price discovery and liquidity, and just overall more investor-friendly markets.
Can I just add one more thing to because what Morgan said really resonated in terms of the liquidity. If you take a $10 million asset and you put it on chain, that does not make it liquid. Just like if you had a $10 million bond and you tried to trade on the stock exchange, it would not be liquid. So I think the misconception around tokenizing it and therefore it will be liquid was definitely in previous contexts, and now we're really realizing that this is not a completely separate capital stack, but this is a stack that it's about the investment first and then the form second.
Okay, so this is interesting, right? We're talking about essentially what the thesis was back then, and I think a lot of it too was around like 24/7 democratization, 24/7 trading, and the sorts, which again still holds true. But I think maybe some of the value adds that people see tokenization as today have kind of changed. Maybe some people talk about settlements or collateral mobility and utility. In your opinion, how has that shifted over the years, and which parts kind of stuck through?
Maybe just to kind of level set in terms of why this time is different from a tokenization standpoint. Obviously, to your point, tokenization isn't new, but it really has kind of ramped up in terms of interest and adoption, particularly from institutions, more on the kind of the asset supply side of the equation. But some of the things that make this time different are the fact that you have DeFi, right? That creates utility for assets once you tokenize it, right? So if I buy into an asset, it doesn't just sit there. I can potentially pledge it as collateral. I can make it more productive. I can earn kind of real-time yield on it potentially. In addition, I think back in 2022, right, you had rates in the real world or the macro world going up, and the value prop for pure on-chain DeFi going down because you had a crypto winter. So you saw a lot of capital outflow from the on-chain world into the off-chain or traditional world looking for sources of yield. And so it really put a spotlight to bring real yield, real uncorrelated to crypto yield on-chain, which partially led to the growth of everyone and their mom launching tokenized money market funds and continuing. And then you also had the proliferation and adoption of stablecoins, which is a key piece of infrastructure, as well as the kind of increasingly zero cost on and off ramping from the fiat world to the digital world that really kind of allowed for the second leg of the tokenization part to actually make sense and again be productive. And then last, I would say, is finally you had real high quality institutions, not just talking the talk, but walking the walk as it relates to actually deploying tokenized assets and funds on chain. So I think all of these things collectively really make this time different. And I think even at this point, a lot of institutions have FOMO, and they're kind of just trying to get into the space, dipping their toe with tokenizing money market funds, but a lot of them have plans to kind of continue to tokenize the broader fund suite, and even some, which we'll talk about, looking to actually put capital at risk on chain as kind of the buy side to a lot of these opportunities.
Yeah, I approach it through a slightly different lens. Definitely think that from the DeFi perspective and allowing for the collateralization of instruments that you own, but I came from the public markets many moons ago, 10 years ago, and went into private markets. And really what was very interesting coming into private markets was the fact that there was a lot of legal infrastructure, but there wasn't the technology or operational infrastructure. And what tokenization really brings, it's not so much about the technology itself, but it's about the ability to scale in a regulated way, the operational, the disaggregation around things. So for example, collateralization always happened within prime brokerage accounts. You could post margin, you could have margin with institutions. Being able to bring that all the way down to the individual level is the unlock that's really happened through DeFi, and that's where we're seeing the acceleration. I think also we're seeing acceleration because there's an entire fragmentation. It used to be 20 years ago, people were part of, mass institutions. Now they're becoming more aligned with communities, more aligned with tribes, and investing with, with those things that they feel very passionate about. And that's something that's really changed, as well as the ability for people to actually invest in things that they're very passionate about.
And just to give a concrete example of efficiencies that you can get from tokenization, at Opacity, we have this unique perspective where we look at tokenization as mainly an identity verification problem. And so we're an SEC registered transfer agent. We have a core technology called zk-TLS, which enables a one-time KYC where you get a credibly neutral, trust minimized verification that you KYC once, and then you can get access to all the securities that you're eligible for. So you get deep secondary liquidity. And if you look at in our conversations with funds, what's really interesting to them is bringing down the ongoing compliance costs of getting global distribution. So if you look at USYC, for example, that's Circle's offshore money market fund, And it's Regulation S, and they limit it to accredited investors only. I think there's like a $100,000 minimum, even though there's no regulatory reason you have to do that. It's just they can't scale the operations to manually KYC retail users across the globe. So if you can automate the KYC process, you can get better global distribution without like having to deal with insane operational overhead in maintaining compliance. There's also other benefits of having like identity built into the protocol level where you can unify the share classes. When you're tokenized, when you have like a fund offering, in the traditional system, you'll have a separate share class for US investors and non-US investors, but if you have identity baked in, you can unify the share classes and just treat them differently. And that streamlines a lot of the back office work too.
Okay, so a couple different things I want to touch on. Shari and Morgan, you guys touched on a couple things that I'll double back on in a sec regarding collateral mobility and the operational efficiencies, which is related also kind of to some pilots that have, and POCs, that proof of concepts that we saw in the early 2020s that maybe have made their way to production. Some of them have not. I want to touch on that in a second, but Hersh, you talked about KYC AML. To what degree are people actually like adopting that? Like, I think that there's maybe a differentiation between like fintech platforms maybe accepting that versus maybe other institutions maybe have their own KYC AML. How are you seeing adoption of that solution specifically?
This is a great question. The core problem of tokenization is how do you do KYC in a decentralized context? And the trick is to not actually sell KYC to regulated financial institutions just because you're selling to like the most conservative department that's really risk averse, the compliance department, right? And so the strategy that we have is as a registered transfer agent, there's a cool trick where if you could do KYC in a purely software defined way, you can actually offload a lot of the responsibility away from issuers, and that's how you can unify the liquidity. And so in our conversations with issuers, it's not that we're selling them a better KYC, we're just pitching them doing it for them.
It's a little bit more on the technical side, right? And really adopting and streamlining the process. It makes sense. Back to kind of like POCs, as we're kind of transitioning from like what's happened in the past to what's active today. We saw like Project Guardian, for example, back in like 2020, I want to say 2022, 23, where it was like automated rebalancing of portfolios, which is good because we talk about, again, the ease of moving assets in and out and so forth. There are some POCs, again, that is mentioned earlier. Some of them made it through and have maybe made it to production. Others of them kind of died out. Which ones, in your opinions, especially those that have been and seen and lived through those, are maybe some of the ones that are in production and actually growing versus others that maybe not so much?
I'll maybe start. The ones that we really see that resonate are those where you're starting with the investor journey and what is the investor looking for, rather than starting with the technology and let's implement, the laser light show, as I like to call it. So, what is the investor looking for? Are they looking for economic rights? Are they looking for governance rights? Are they looking for access? Are they looking for a combination of all three? I know we're going to get to private credit in a little bit, but certainly with private credit, we can talk about some resonant use cases that we're seeing. Another resonant use case is Angel Studios. So we've worked with Angel Studios over the last few years. They're a movie studio. We worked with them for about $80 million raise, over 100,000 different investors, and they had both economic interests as well as actually voting, greenlighting the slate of movies. So that's something that really resonated with the community, and for the issuer, it helped them create a very engaged community that not only supported them from a capital formation perspective, but also helped strengthen the tie of that community and grow the outreach.
I'm still hopeful that Project Guardian vision of on-chain rebalancing will happen, but I mean, before you even get there, right, you need to tokenize assets, create liquidity, all the things that kind of precede that ultimate vision. I think a lot of the tokenization initiatives to date have been tokenization of funds, which, despite all of what we talk about from an operational efficiency perspective, what happens is when you tokenize a fund, you're introducing the technology so far downstream in the asset issuance and management lifecycle that you end up having to dual administer the asset. And oftentimes, frankly, from an investor like user experience, the onboarding and the friction is actually worse, and the operational efficiency is really not there because you're dual administering the asset. And so there is like a time and place, and we'll talk about money market funds and the adoption of those things to date, but where we've largely, in addition to that, been focused is introducing the technology as far upstream as possible to the point of origination, whether that's native on-chain equity issuance or loan origination. And what happens is, to the extent that you can accomplish that, that really opens the door for leveraging the on-chain version as a source of truth for verification and servicing and the asset life cycle and management that actually creates the efficiencies where you might need to therefore, or you can remove the third-party intermediaries that were created because historically the system was operated by various disparate systems, the need for message passing and reconciliation. So we'll talk about private credit, but that's really where we actually see the operational benefits and efficiencies, is to the extent that you can originate something on-chain from the beginning, that really kind of opens the door for the efficiencies that we've been talking about for years.
So not just creating a wrapper.
Right.
Correct.
But, yeah.
And this is really where tokenization is starting to find its different forms, right? One is access to the fund itself, whether it's a share class of a fund and you just want issuance and easier fractional access that we talked about in the early days, and now we're talking about the actual fund or securitization of loans, right? All of it starting from the very beginning, inception, to then carry over to distribution and eventually DeFi utility as well. So let's talk about private credit. Let's hop in. Tell me about where you maybe saw private credit start, and maybe let's give some context on like the traditional, TradFi side of private credit and where it kind of stands, and why tokenization is starting to become more and more of a topic around that specific asset class.
I don't even know where to start. Okay, so maybe just to take a step back, generally when we've been saying private credit, and obviously private credit has been getting a bad rap lately from like the more macro picture, but specifically within the world of private credit, we've been really focused on asset-backed finance and fintech lending, just separate than like SME or direct lending. That's been kind of dominating the headlines. And so within this space, and kind of talking about what I was alluding to earlier, is that space today is riddled with third-party intermediaries and verification agents and trust agents and payers and a ton of reconciliation and Excel sheets and PDFs that are passed from one party to another on the 30-day delay, and adds therefore a ton of extra intermediary fees between the ultimate borrower and the ultimate lender. And so the idea is, if you can, again, originate something on-chain today, it ultimately, at scale, removes the need for a lot of these third-party service providers, and therefore can provide an ultimate, more attractive rate to both the borrower and even the lender. And so really that's kind of the space that we've been focused on, and that I think can bring to bear a lot of the efficiencies, especially as the asset-backed finance space has grown. We've seen the growth of like BNPL and receivables financing and things that turn over very quickly, which traditional financial services rails can't basically address in real time at scale, and which partially leads to the delays. And so what we've found is, especially in kind of uber short-term, high turnover receivables, leveraging this technology plus stablecoins has really allowed for even traditional fintech originators to come on chain and benefit. And when we see, like, from their perspective that it's actually solving a real-world problem for them, right? They don't have to spend half a day every week reconciling an incoming loan request against the terms of a facility. They can draw down from a facility on a daily, if not intraday basis, as opposed to on a weekly basis. All of these things, and also for lenders, the fact that you can prevent double pledging of collateral and fraud and things that are actually plaguing the real world. It's a novel concept that this technology is actually helping to solve real world problems. And so that's, those are some examples of what we're excited about.
What I love about this is we're actually seeing it from a different lens or a different standpoint. It's really working with the lenders who are now, they're lending at really large tranches, and they're looking to go downstream and assist with family offices, smaller buy sides, to be able to access private credit, who don't necessarily have the capacity to do the due diligence, the capability to do the due diligence, but are really looking to get access to private credit. So for example, if there's a lender that has taken on call it 500 million of a particular tranche, the ability to then distribute that down as a loan participation in $1 million, $5 million tranches to smaller institutions is where we're seeing the need. So it's actually really interesting to kind of piggyback on what Morgan's saying. It's facilitating that distribution at scale within the buy side.
So I actually have a question for you guys on this. For private credit, the main problem in the traditional financial system is a lack of secondary liquidity, in my opinion, on the investor side, where if you're raising capital for a private credit fund because your investors can't really exit unless they redeem, you're going to have to pay them an illiquidity premium. But if you can just dump your position on an AMM or a DEX with deep secondary liquidity, you can bring down the lower cost of capital. There's an assumption of if you can have price discovery there, where like you were talking about how private credit traditionally it's all in like fragmented Excel spreadsheets and it's not verifiable, right? But I would argue that's a feature, not a bug, because if you're a big private credit, like an Apollo private credit, for example, you don't actually want transparency or price discovery because you actually make money off the opaqueness. You just get like a opaque bundle of loans and you sell it off to like an insurance company for a premium. So I agree, there's a huge opportunity for tokenization in private credit, but do you think that like the big private credit players today are going to take advantage of that, or is it just going to be like entrepreneurs come in who crack the disruption or the origination problem and disrupt the market?
Can I answer? So, not speaking on behalf of Apollo, but Apollo is looking to implement more frequent pricing so I actually think some of the more forward-thinking institutions are actually looking at this and saying, yes, there is opaqueness, but we can actually create an opportunity here by having more frequent pricing, by having less opaqueness, and very similar. So I grew up forever ago when public equities were traded on the New York Stock Exchange and on NASDAQ and went to, a lot of the specialists didn't like the fact that that electronic trading came to bear, but a lot of those that were more forward-thinking saw an opportunity because you increase the velocity and you can actually, there's more turns. So you actually increase the velocity, you increase the market. I think some forward-thinking institutions like an Apollo who has publicly stated that they're looking for daily pricing marks. I think it's by the end of the year, they're going to be establishing themselves and others in this space where there's more velocity, there is that secondary market component, and that's going to really differentiate the players in the space.
My hot take there, though, is Apollo wants to do that because there's a big crunch in the private credit market, and they just have the best assets out of anyone else, so it's in their interest to force like more frequent price updates on the NAV, even though by the economics it's not necessarily in their interest. But there's like actually a technical problem here where it's not really like your net asset value, how is that measured? It's, I would argue, how much you would get for selling a particular loan or a bundle of loans, right? And the aggregate of that is the net asset value for your fund. If you don't, today you don't really have secondary liquidity on those assets, at least good secondary liquidity, so you can't get price discovery. And so there's like a liquidity problem like that goes all the way down that you have to solve to really get like the best, most frequent price updates in the actual net asset value for a private credit fund.
Maybe just to clarify, I think from like, again, don't want to speak for Apollo, but from an asset manager's perspective, they do want clarity and transparency as it relates to the underlying collateral against which that they're lending, right? And because if they don't have that, then you have blow-ups like Tricolor and others where there was double pledging of collateral, fabrication of invoices. And so I think it behooves them from a private credit investor's perspective to have that transparency as it relates to like originator collateral, for example. I'm not sure that whether from an originator's perspective or a lender's, that they necessarily, even though the secondary market has kind of grown in size, I don't necessarily think, especially for like an Apollo who has Athene, an insurance company, and a very low cost of capital and a very long like investment horizon, that they necessarily want to turn over their portfolio fairly quickly. And I think from an originator's perspective, they look at a partner like Apollo as kind of being there for 2, 3, maybe even longer years. And so I think that there's certain dynamics which just a little bit more nuanced. And obviously we had like the BDC companies which opened up to retail, and that was a different kind of purpose. And so I just think it's kind of making your statement as it relates to certain, like it's not a blanket kind of observation.
More nuanced.
So is there like a need or a fit for maybe like permission transparency, or maybe zero knowledge to a degree somewhere in there, right? Like maybe certain parties need the transparency in seeing that versus others that maybe don't. And I bring it up because like you guys are working on privacy. Also, you have the L1s on Avalanche, so just curious on maybe where that kind of fits, if at all.
What would be really interesting, and this might be a little bit away, but if you're lending to, let's say, a big rental property as a private credit fund, just as an example, if you could have, like, whoever's taking the loan prove whatever their occupancy is, like how many payments they're getting on a monthly basis, and it's just like automated, and that's fully transparent up to the actual investor, so you get better transparency on the secondary market at the actual fund level. That's like the ideal case. It might take a few years to get there. There's a nasty cold start problem of how you actually achieve that. But in my mind, when it comes to like the best transparency you can get into like credit assets or debt assets, it would be something like that.
I was just going to say, and this is probably rudimentary, so apologies, but I definitely think from a credit perspective, the fact that so many of the credit instruments are asset-backed makes it fundamentally, should be much easier to value and see the income streams, to see the assets behind them and the valuation of those assets than, for example, equities, where you've got, you know, you've got a very different valuation that may have software and what is the enterprise value of that software. So that, I definitely think private credit, while it hasn't traditionally had the transparency associated with it, we definitely can get there.
Understood. And we're going to have panels, by the way, on private credit specifically. We're going to have an Invenium keynote on data around private market assets and the sort. So plenty to dive into all this. But I know today's panel is a lot about product market fit. And product market fit has certain different definitions, right? You have like commercial type of businesses that have their definition. How would you define, let's start there, how would you define product market fit for tokenization and specifically in institutional use cases?
I think from an institutional use case perspective, we've not reached product market fit yet. What we've seen from institutions is them tokenizing their existing funds, their asset supply. Ultimately, the idea is and why a lot of asset managers started with money market funds was in an attempt to convert a lot of the idle stablecoin balances that retail and crypto native institutions have into yield-bearing money market fund products to earn, you know, yield on idle balances. And that has succeeded to varying degrees. The large majority of uptake that we've seen in that space has been by stablecoin and synthetic dollar issuers buying money market funds and starting to kind of wade into the world of credit or other fixed income products. How I would define product market fit from an institutional perspective is when you actually see these institutions deploying capital on-chain, capital at risk, and they're using the technology because it actually upgrades a legacy institutional workflow. They're accessing an existing product, but it's better because it has better kind of controls and risk and compliance, or because it offers a better rate of return, or it's easier to access. And we haven't seen that today, but I'm confident that we'll see that within the next year. And I'm very excited for that time to come because it actually means like institutions are, again, putting capital at risk, and they're doing it because there's a reason to access this asset on-chain versus off-chain.
So They'd be like putting their money where their mouth is. 1 year, that's a quick.
You heard it here first.
Yeah, quick institutional timeline there, relative. So curious to hear the rest of the panel's thoughts though on PMF.
My favorite definition of PMF is when the market pulls a product out faster than you can actually build it. And given if we're asking about whether we have PMF, we probably don't by that definition. But from my perspective, like here, we filed for Section 36 exemptive relief with the SEC. We've met with the SEC a bunch of times, and I think there's for the U.S. market specifically, if you want like DeFi, tokenized securities and funds, there's a bottleneck on the regulatory side, which I think will get resolved. The regulators just move much slower than we'd like, but an analogy I'd like to draw is for the like mutual funds have been around for a long time, but the SEC never let them trade like on secondary markets because there's a concern of like having the price on the market diverge from the net asset value. In the 90s, the ETF was a great innovation where you could like redeem in kind and you could keep a strong peg to the net asset value. And the ETF market really quickly ate up the mutual fund industry just because it's just a better product or a better instrument. And like a tokenized fund, I think would be the same, like what ETFs did to mutual funds, tokenized funds will do to traditional ETFs. And when that happens, we'll know that we have PMF.
So again, we're approaching this a little bit differently because we work with a lot of issuers and we work with a lot of people that are putting capital at risk. And it really, what we're seeing, the use cases that are working is where the issuer is really starting with the investor journey and what does the investor want and aligning the investor needs with the structure, the actual structure of the investment, rather than just putting something on chain and saying they will come. So that's really where we're seeing a lot of product market fit, and I think we're going to see this extend across into the institutional space over the next year. The regulatory clarity that's coming is very encouraging, and so I think that's going to open up a lot of opportunity.
Okay, and actually let's touch on that. So you're talking about maybe like issuances, and this is, by the way, why I love this panel, because he has different perspectives and points of view on tokenization itself and how you're executing it. And you're talking about maybe like the use case of maybe like more individual investors and the issuers that are catering to them versus the types of assets and products that institutions would want to deploy to. What else is needed, by the way, infrastructure-wise, legacy infrastructure-wise, to get us there, right? Because there's still custodians involved, there's still transfer agents, fund admins, the front to back, right? So what else is needed in the legacy world to come on chain, or at least be blockchain compatible to be able to support that at scale?
Yeah, I mean, I think like historically, again, the on and off ramping was a blocker because it was prohibitively expensive. That's obviously come down and is continuously trending towards zero. I think there's certain things that exist from like a regulatory standpoint that even though the technology has like gone ahead, but far beyond the regulatory environment, as long as you need certain kind of regulatory requirements, like a custodian, for example, like you will have to have traditional custodians be able to kind of support tokenized assets and tokenized securities as one example. I also would ultimately love to see the integration of wallet infrastructure and tokenized assets kind of as the back end to traditional platforms like a Bloomberg or an Aladdin, a traditional kind of OMS, where from an institutional perspective, it's totally abstracted away and they don't know or care that they're buying a tokenized money market fund or not. So some of those kind of connectivity points with the traditional world, I would love to see, and I'm confident that we'll get there because I know a lot of institutions, banks and asset managers and FMIs are working on it, but those are some examples.
I would totally agree with that. I think we spend a lot of time talking about the technology behind it, but in the very near future, we're not going to be necessarily talking about is this wallet-based or what is the back end? What do all the wires connect to? It's really about the investor experience and what the investor experience opens up. So, for example, there are certain investors. I've been talking about individual investors, but we can also use the same for family offices and then institutions. run the gamut between, do you need a transfer agent, do you need a custodian, do you need a tri-party agreement in the middle of it, and that really is a spectrum. So how do you align those different intermediaries and provide the connectivity in the back end? I think we all would agree that, in the future, that's going to be completely transparent to the investor. Most of our clients don't even know that tokenization's on the back end. They just know that we provide a service in a cost-effective way.
As an entrepreneur, my mind goes directly to the cold start problem where it's not that there's something missing, we just have to bootstrap the network and get the network effects going on compliant, decentralized liquidity, let's say. So to use another analogy, I liken this a lot to early Visa, bootstrapping the Visa network, where to do a Visa-style network, you need merchant banks, you need the consumer, and you need the actual merchants themselves. If you just went out the gate, tried to align those parties in the beginning, I think you'd horribly fail. It'd just be way too hard. Visa worked because Bank of America did Bank of America card themselves first in California, and then they leveraged that eventually into a global network play. And so I think that we just have to bootstrap a compliant, decentralized liquidity with good securities that people actually want. Let people borrow against them on lending protocols in DeFi. And then you can get the network effects going. Pretty soon here, we're going to get started on offshore issuances, and people can trade them without a registered broker, exchange, or a clearing agency. For U.S. retail investors, we have to wait for the SEC to get on board with it, but we just have to bootstrap it.
I would just say that the SEC, so there are broker-dealers right now that can trade digital securities, tokenized securities, on the secondary market. It really is about having not just good investments and the secondary market liquidity, all of the characteristics there, but also about having the diversity of investor flows. So I worked on a number of alternative trading systems, and really it was about how do you get a diversified base in there. So you can't just have all buy side, you can't just have all sell side. You really need that diversification so that you've got an interesting or the right mix of velocity around the secondary market.
Just to give an example on that, where I would push back on that is if you look at Masterworks, for example, that's an asset class I think a lot of retail investors would be interested in investing in, and retail investors can invest in it, but I believe they have their own ATS, or maybe they use someone else's, but if you were to invest in Masterworks to exit your position, you're going to take a 10% haircut because there's just not enough liquidity. And so because of the lack of liquidity, it becomes a less attractive investment. And this is a problem that plagues all the alternative assets in the US and all over the world. So the real unlock, it's how do you get deep network effects around compliant liquidity that don't fragment around the issuer or a broker or ATS in the middle, but you just have shared liquidity across all the assets?
So, yes, definitely no Masterworks, and really the issue goes back to the $10 million issuance. So you buy a slice of Picasso, how many people want to, if you're selling that slice of Picasso, how many people on the other side want to buy the slice of Picasso? I think it would be analogous to what you were talking about with the ETFs. So the ability to form actual products that bundle that to make the market cap large enough where you've got the diversification of investor base where you both have the buy side and sell side.
So with Masterworks, you can only sell to other people who've KYC'd with that particular ATS, right?
Correct.
The difference I'm drawing is you'll have the problem in the beginning when you're bootstrapping the network, but if you have, let's say $1 billion of compliant liquidity on the network that's tokenized, that people can trade, the next asset that comes along shares in the same liquidity pool as that, and so you get there's a really strong network effect there. So you get deeper secondary liquidity, you get better price discovery. If you fragment the liquidity across ATS or a broker, or even through the issuer in some models, you lose that benefit.
I would maybe just add, like, I mean, it's obviously very difficult to bootstrap a two-sided marketplace, regardless if we're talking about Masterworks or anything. I think like a good example in the Web 2 or traditional world was Lending Club. It was meant to be a peer-to-peer, two-way marketplace, which failed in that capacity, right? Because there wasn't sufficient liquidity or interest on both sides. And as a result of that, they had to kind of draw in from private credit funds to take the other side and really kind of step in and provide that liquidity. So that's right. I don't know if necessarily it will just be retail or peer-to-peer or kind of fully decentralized. Maybe the answer is somewhere in the middle, especially with this technology enabling the easier flow of assets and capital. So I think it'll be interesting to see how it unfolds.
Lots going on here. Some of it is regulatory. We need to have those intermediaries. I will say there are a lot of new fintechs that have gotten their licenses. We saw OCC Trust Charter banks that are qualified custodians and so forth that have those capabilities. We've seen a lot of partnerships like NASDAQ and NYC partnering with other fintechs as well. So lots going on for sure. Part of it is partnerships, part of it is building it. It's a question that a lot of them have to answer. You buy, build, or lease the technology, which we can all dive into, but I know we're almost at time. So temperature check, what use case is the most overhyped right now, and which one's the most underappreciated for tokenization?
I don't want to say overhyped because I know a lot of people are working on it, but I think tokenized equities, it's just to have native on-chain equity issuance, it's going to be a big to-do to convince a lot of issuers and brokerages and retail to kind of build out that space. I know there's a lot of traditional players that are working on it, but I think it's going to be like a long journey. What was the other one? Underappreciated? Honestly, I'm not over stablecoins. Like, I think stablecoins have a ton of kind of usage and utility, and I think we're going to continue to see adoption of stablecoins in both the institutional and the retail side of things. And I think increasingly from a tokenization standpoint, just going back to product market fit, we're going to continue to see a lot of partnerships between kind of crypto native or tokenization platforms and traditional fintechs, wealth tech platforms, and neobanks. Companies who already have adoption and a customer base and distribution start to offer a lot of these kind of blockchain-based products and services to their customers, and I think that will help to really drive adoption. So I would say not underappreciated, but I think we'll continue to see more of that.
Yeah, I would agree with the tokenized public side, just because I feel like trading free on Robinhood, not much more incremental value there. In terms of the most underhyped, I think it's the unlock of assets that traditionally haven't been accessible to different distribution networks, whether that's family offices or individuals, and real alternative assets that music royalties, other areas like that. I think we'll see a big growth in that over the next few years.
I think the most underrated tokenization opportunity is also the most boring. Is just a tokenized U.S. money market fund that like global retail investors can access. That doesn't really exist today, as far as I'm aware. Like USYC has like minimums, like $100,000 minimum, and like DeFi right now, a lot of the yield opportunities are drying up. I'm pretty sure the lending protocol yields are lower than the government money market funds, and especially with all the hacks recently. People are probably going to price in smart contract risk more into those opportunities. And so if you could just provide the yield behind a stablecoin at the same risk of holding a stablecoin, that seems kind of like a no-brainer to me.
All right. And with that, we are at time. Thank you very much. A round of applause for a fantastic panel today.
Thanks.